So far, we've looked at step one of the accounting process, which was to analyze the transaction. Now, let's look at step two, which is to record. Once you analyze and you've seen the impact on the accounting equation, the next step is to go in and record the transactions. When we analyze the transactions, we use plus and minus to show impact on each type of account. Do you believe this is a logical way to record our transactions? Well, yes, it's logical, but it is not a proper means of recording. We record transactions in what we call a general journal. It is a chronological listing of all transactions that impact the accounting equation. But before we can record, there's a new concept we must learn, and that is the concept of debits and credits. The term debit means left, and the term credit means right. A debit is abbreviated DR, and a credit is abbreviated CR from their Latin roots. So let's look at the accounting equation again. Remember, the accounting equation stated that assets equal liabilities plus our owner's equity. Notice what's on the left side of the equation and what's on the right side of the equation. So when you look at this, assets are on the left and liabilities and owner's equity on the right. So by definition, if a debit means left, then assets would be increased with a debit because assets are on the left side of the transaction. Well, the opposite would be true for the other side. Liabilities and owner's equity are on the right side of the equation, so that means those accounts are increased with a credit. All right, so now that we have the basic concept of debit and credit, please do not think of debits and credits as plus or minus. It is not a plus or minus. Debit means left, credit means right. So assets are increased with a debit, but they're decreased with a credit. Liabilities are increased with a credit, but they're decreased by a debit. So notice how it flips. A debit can either be a positive or a negative depending on the type of account. So keep that in mind. Debit means left, credit means right. All right, let's look at some transactions here to see if we can figure these out. So the first one, Patricia Johnson opens Healthy Habits on September 1st. She organizes the business as a sole proprietorship and invests $100,000 into the business. Remember, the first step is to always analyze to determine the impact on the equation. So let's talk about this. What's happening to our business? Well, our owner is investing $100,000 in our business. $100,000 represents cash, so cash is an asset, liability, or stockholders' equity. Or excuse me, owner's equity, not stockholders' equity. We're dealing with a proprietorship. So let me fix this. This would be owner's equity. Cash is an asset. So our assets are going up by $100,000 in the form of cash. Now, why is our assets going up? Did we sell an asset? No. Did we borrow money? No. Did our owner contribute? Yes. So what we need to look at then is our equity is going up $100,000, and for a proprietorship we call that capital. And specifically this would be Johnson's capital here in a few moments. Now, we've analyzed the transaction. We know the impact to our accounting equation. Let's put it in proper journal form. Let's debit and credit the accounts. Now, cash is going up. We say cash is an asset. Are assets increased with a debit or a credit? Assets are always increased with a debit. So since our cash is going up, we're going to debit our cash account for $100,000. Then we're going to credit our capital because owner's equity is going up in the form of Johnson Capital. And in order to increase equity, you credit the account. Now, keep in mind, for every debit, there must be an equal and offsetting credit. Our transactions must be in balance. So debits on the left, credits on the right, the transactions must balance. Now, let's talk about good journal form for just a moment. I require that everyone uses good journal form. Good journal form means your debit is always listed first in the transaction, followed by your credit. Your credit is always listed second, and you always indent your credit. Now, before we do the next transaction, if we were doing multiple transactions in a row here, you would leave one blank space and then you would do the next transaction. Okay, that's considered good journal form. All right, let's look at another transaction. Healthy Habits borrowed $50,000 from a local bank on September 12th. The company signed a formal agreement to repay the balance in 2 years. So let's first analyze this transaction. What's happening here? Well, we're borrowing $50,000. We're borrowing money. So what happens to our accounts when we borrow money? Well, $50,000 again represents cash, and that cash is coming into our company. Now, why is that cash coming in? Did we sell an asset? Did we borrow money, or did our owner contribute? Again, let me fix this. It should be owner's equity. Well, in this case, our owner did not contribute anything. We actually borrowed funds, so that means we owe money. So that means our debt, our liability, is going to go up for our company. And since this is a formal agreement, remember we said when we owe money, that's considered a payable. And since this is a formal agreement, it would be a notes payable. Okay, so notice assets are going up, liabilities are going up. Well, let's apply the rules of debits and credits. Assets, cash, going up. Do we debit or credit that account? Well, remember assets are on the left, so we need to debit that account. Let's talk about liabilities. Liabilities here are going up in the form of notes payable. How do we increase liabilities? Well, liabilities is on the right side of the equation, so therefore we need to credit that account. So let's journalize this. Remember we said we debit cash. Cash is the debit, so it's going to go first in our transaction. Then we follow it with an indented credit to notes payable, and that notes payable account is going to get a credit of $50,000. Again, we'd leave a blank line. This is our formal journal. Now, right now we're ignoring this reference column. The reference column is important, but not until we get to the next step, which is posting, and we'll talk more about that at a later date. All right, let's look at number 3. Healthy Habits purchased equipment on September 20th for $25,000, paying $5,000 down and placing the remainder of the balance on account. Well, let's first analyze this transaction. What's happening here? Anything happening to our assets? Well, we purchased equipment. What is equipment to our company? Does equipment bring you benefit? Is it something you owe, or is it an owner's claim? Well, equipment brings us benefit, so we know we're purchasing equipment. Equipment is an asset, and the value of our equipment is going up because we're buying it for $25,000. Remember, historical cost principle in accounting states that you must record assets at their historical cost. So $25,000 up in equipment. Now, how are we purchasing that equipment? Are we paying cash for it? Or are we borrowing money? Well, we're actually doing a little bit of both, because in this case we paid $5,000 down. So in other words, we made a cash down payment of $5,000. Well, when you pay cash, what happens to your cash account? Correct, it goes down. So we're going to take our cash down by $5,000. Well, we're not in balance. We've got a $20,000 net change in assets, but we have nothing else to offset that. Remember, we bought $25,000 worth of equipment. We've only paid $5,000 of it in cash. So where does the remainder of that balance go? Well, it says we replace the remainder on account, which means we still owe money. Remember, we said when we owe money, we typically call that a payable. And in this case, is it a formal document or is it on account? This is on account, so it's accounts payable. And how much? Well, we bought equipment for $25,000. We paid $5,000 down, leaving us a balance of $20,000. So our accounts payable is going up by $20,000. Now let's translate this into debits and credits. Remember, assets are increased with the debit, they're decreased with the credit. So are our assets increasing or decreasing? Well, a little bit of both, right? Our equipment is going up by $25,000. So to take equipment up, we need to debit that account. Cash, on the other hand, is going down. So to take that cash balance down, we would need to credit cash. Okay. So we've got one debit to equipment, we've got a credit to cash. Now let's talk about accounts payable. Accounts payable is a liability. Liability is on the right side of the equation, so to increase a liability, we would need to credit the account. Again, debits go first. Our equipment is going to get the debit at $25,000. Then we follow that up with our credits. Now, the order of the credits does not matter. You can put them in any order as long as they fall after the debit. So you can put cash of $5,000 first, or you could put the accounts payable first. It does not matter. They, as long as you get the credits together, is all that really matters in that case. So notice we debited for 25, we credited a total of 25. This is called a complex entry because we have more than one account, or one debit, one credit, excuse me. A complex entry or a compound entry because we have more than one debit or credit. Okay? But remember, debits must always equal our credits. So again, a compound entry because it has two accounts versus one in that case. All right, let's look at the next transaction. Healthy Habits purchased 1,000 in supplies on account on September 25th. All right, so we purchased 1,000 in supplies on account. Well, supplies is going up, and that's an asset. So when we analyze, we're going to say, okay, assets are going up by 1,000 in the form of supplies. And then, did we pay cash for those supplies, or did we charge them? Well, they're on account, so that means we charge them to our account, which means we now owe money. And remember, we call when we owe money a payable, and payables are liabilities. So our liabilities are going to go up by 1,000 in the form of accounts payable. Now let's translate that into a journal entry. So pause the recording for a minute and see if you can journalize this transaction. All right, hopefully you paused and gave it your best. Let's talk about it. Supplies are going up. Supplies are on the left side. It's an asset. Do we debit or credit? We're going to debit our supplies, and we're going to debit it for $1,000. Okay? Now, accounts payable, it's on the right side of the transaction, and to increase on the right side, we need to credit the account. So our accounts payable is going to go up by 1,000. So how did you do practicing that transaction? Hopefully you were able to journalize. All right, let's look at one more. Healthy Habits provided nutritional classes to customers and received $1,500 in cash for the month of September. All right, so again, we're providing a service. We're doing nutrition classes here. And we've performed the class and we've received the $1,500 in cash for that month. Let's talk about what's going on here. Well, we received $1,500 in cash, so what's happening to our cash account? It's going up, and we've determined that cash is an asset, so our assets are going up by $1,500. Now, why is our cash going up $1,500? Is it because we're taking on debt, or is it because of owner's equity? Well, in this case, it's going to be because owner's equity, because when an owner earns money for the company, it is part of their claim against that company. So equity is going up, and equity is going up in the form of a revenue account. Okay, and in this case, I'm probably going to be more specific and call it a service revenue account. All right, now that we've looked at that, let's record the transaction. Cash is going up. Cash is on the left side of the equation, so it's going to get the debit for $1,500. And then our equity is going up. Remember, revenue and capital increase equity, whereas expenses and drawings decrease equity. So revenue is increasing equity. Equity accounts are increased with a credit. So we're going to credit our service revenue. Now that we've done all the transactions, let's look at what our journal looks like today. Notice this is, again, good journal form. We put the debit first, followed by the credit, and then we left one blank space, okay? All right. Hopefully this has helped you understand the rules of debits and credits and gave you a few examples to assist. Please print off this handout, watch the video, and bring it with you to class. Have a great day.